This week, the world's second largest economy is stumbling, and the alarm is sounding across the globe at China's worsening economic outlook.
From President Xi's perspective, he's described the strong resilience, tremendous potential, and great vitality of China's economy.
Property is arguably a ticking time bomb. I'm not a fearmonger, but I see things getting notably worse over the next 5 years than notably better.
It's just one of many companies in China, developers, are struggling. You're talking about the most overvalued housing market in the world. I mean, Evergrande is just the tip of the iceberg. The problem is massive.
China, the world's second largest economy, lifted 800 million people out of poverty in just 4 decades. For years, Beijing's model looked bulletproof with endless infrastructure, cheap labor, and a flood of foreign investment. But in 2025, China, once hailed as the unstoppable economic engine, is staring down a financial downfall. It's running on borrowed time and borrowed money. Not just any debt, the largest pile of borrowing in human history. China's total debt, from households to corporations to government, has exploded to over 312% of GDP, a figure that puts China not only among the most indebted nations on Earth, but ahead of many developed economies despite still being classified as a middle-income country. That's worse than the US, worse than Japan, worse than almost any major economy in history. Now, this is not just an accounting problem. It's a structural, systemic, and global risk, the kind that could reshape trade flows, unsettle emerging markets, and test the world's financial system. So the question is, how did the world's fastest growing economy in living memory build such a dangerous debt mountain, and what happens when it starts to crumble? So let's rewind to the early 2000s. For 3 decades, China's economy grew at a pace rarely seen in modern history. From the early 1980s to the mid-2010s, GDP growth often averaged above 10% annually, lifting more than 800 million people out of poverty according to World Bank data. The country transformed into the factory of the world by dominating global exports in electronics, textiles, steel, and machinery. And this transformation was underpinned by 2 main drivers: cheap credit and high investment spending. Local governments borrowed heavily to finance infrastructure such as high-speed rail networks, industrial parks, and new urban districts. And by 2020, China had built over 40,000 kilometers of high-speed rail, more than the rest of the world combined. The strategy worked as long as global demand for Chinese goods remained strong. However, debt accumulation began to accelerate well before it became a visible concern. The inflection point was the 2008 global financial crisis. As the United States and Europe fell into recession, Chinese exports dropped sharply, by over 20% year-on-year in early 2009. To counter this slowdown, Beijing launched a 4 trillion yuan, about $586 billion package, equivalent to roughly 13% of GDP at the time. The funds were directed toward infrastructure, real estate development, and manufacturing capacity expansion. Credit growth surged as state-owned banks were encouraged to lend aggressively, especially to local government financing vehicles, LGFVs, and property developers. This strategy succeeded in avoiding a recession. China's GDP still grew 9.4% in 2009, but it also established a debt-dependent growth model. Total debt, including government, corporate, and household, jumped from about 140% of GDP in 2008 to over a staggering 170% by 2011, setting the stage for the unprecedented debt pressures the country faces today. By 2024, China's total social financing, TSF, a comprehensive measure that includes bank loans, corporate bonds, shadow banking credit, and other forms of financing, had reached 430.2 trillion renminbi. To put that in perspective, this figure is more than 3 times the size of China's annual GDP. At the end of 2023, the country's debt to GDP ratio already stood at 303%, and by mid-2024, that figure had climbed to 309%, an increase of 6 percentage points in just 6 months. Such a sharp rise suggests that borrowing is still accelerating despite an already historically high debt load. The pace of credit expansion far outstrips economic growth. Since the 2008 global financial crisis, China's credit stock has been growing at an average rate of 8.9% per year, compared to nominal GDP growth of just 4.1% over the same period. The result is a widening gap between the amount of debt being created and the value of economic output being generated from it. This gap points to declining returns on investment, a classic sign of diminishing marginal productivity of debt. And on a global scale, China's debt growth is not an isolated phenomenon. According to the International Monetary Fund (IMF), more than half of the increase in the world's debt to GDP ratio since 2008 is attributable to China. In other words, over the past 15 years, no other single country has contributed more to the rise in global indebtedness. This makes China's debt dynamics not only a domestic concern, but also a potential systemic risk for the global economy. If credit growth in China stalls or reverses sharply, it could have ripple effects through commodity markets, global supply chains, and international financial stability. While corporate and household borrowing have surged in China, local government debt has emerged as the most dangerous fault line in the country's financial system. By 2023, official local government debt reached 92 trillion yuan, roughly 76% of GDP. But that figure doesn't capture the full scale of the problem. According to S&P Global, so-called hidden liabilities, mostly channeled through LGFVs, add another 40 trillion yuan, around $5.8 trillion to the total. LGFVs were originally designed as an off-balance sheet workaround, allowing local authorities to raise funds for infrastructure projects without breaching official borrowing caps. Many of the projects they financed, right from underused industrial parks to loss-making transport hubs, generated little or no revenue, making repayment increasingly uncertain. The repayment schedule itself is difficult. Nearly 15 trillion yuan in local government bonds, more than 40% of the total outstanding will mature within the next 5 years. Serving this wave of maturities will require either refinancing at higher interest rates, diverting funds from essential services, or securing additional central government support. Several provinces are already operating near the Ministry of Finance's danger threshold, where total debt equals 120% of annual fiscal revenue. Once that line is crossed, the ability to take on new borrowing without triggering a financial crisis becomes severely limited. It is now one of the most immediate and structural risks to China's financial stability, and, by extension, to global markets. For decades, real estate was the cornerstone of China's economy. The main store of household wealth, the cash machine for local governments, and a perpetual growth engine for developers. Builders borrowed to construct. Buyers borrowed to purchase, and prices seemed destined to climb forever. That illusion shattered in 2021 when Evergrande defaulted, setting off a collapse that rippled through the entire property sector. By 2025, average home prices had dropped 20% over 4 years, and analysts warned they could fall another 10% before stabilizing, not until at least 2027. The sector, once accounting for a quarter of China's GDP, is now contracting for the 4th consecutive year. New home sales are forecast to fall 15% in 2025, dragged down by weak demand, tighter credit, and a glut of unsold and empty units. The psychological damage may be even greater than the economic hit. For millions of Chinese families, property was not just a place to live. It was a savings account, retirement plan, and status symbol all in one. Today, for many, it's a depreciating asset that drains rather than builds wealth. With consumer confidence cracked and the property market no longer functioning as a wealth engine, China faces a deeper challenge: how to replace the sector that once powered both economic expansion and social stability. China's investment-driven growth model has created an economy that can build far more than it can consume. The country now produces more steel, cement, and electric vehicles than its domestic market could possibly absorb. By August 2024, capacity utilization had slipped to 74.9%, lower than India, which is 76.8%, the United States 77.96%, and Germany with a 77.4%. Entire industries, from EVs to solar panels, are locked in brutal price wars, selling below cost just to keep factories running and workers employed. Even President Xi Jinping has openly warned about the dangers of this low-price competition, urging the retirement of outdated capacity. But shuttering plants means layoffs, a politically dangerous move in a country where employment stability is a core priority. And yes, the result is a cycle of overbuild, oversupply, Price collapse, repeat, and each round leaves more corporate debt, weaker balance sheets, and greater pressure on local governments already straining under record liabilities. Now officially, China's banking system looks stable. The non-performing loan NPL ratio is 1.65%, but many analysts believe this understates the problem thanks to extend and pretend, rolling over bad loans to avoid recognizing losses. Also, stress tests by the People's Bank of China suggest major banks could see their capital adequacy ratios drop from 14.8% to 14.5% by end 2025 in a mild downturn. Smaller regional banks, heavily exposed to property developers and LGFVs, are even more vulnerable. Beyond the official system lies a $7 trillion shadow banking sector, about 16% of the world's total. Much of it channels funds to the very sectors now under greatest strain: property, overcapacity industries, and local governments. Now, the danger here is opacity. Regulators often can't track risks until they surface in the form of defaults. And in a credit crunch, shadow banking dries up faster than formal lending, cutting off a key lifeline. And now Beijing's current strategy is a 3-year debt restructuring plan, refinancing 10 trillion yuan, almost $1.39 trillion of local government debt. But Fitch estimates this covers only a quarter of hidden debt. The rest remains unaddressed, quietly acquiring interest and risk. Economists also warn that delaying recognition of losses only increases the eventual bill. As one expert put it, half measures only add to the final cost of resolution. So China is no longer just a global manufacturing hub, it's also a major creditor. In 2025, the poorest nations in the world will pay $22 billion to China in debt repayments, the highest on record. But the interesting part is, once a source of global capital, China is now a net drain on developing economies. A Chinese slowdown also sends tremors through commodity markets, supply chains, and investment flows. Every yuan of debt is a promise, and when those promises can't be kept, someone must take the loss. Whether it's banks, local governments, the central government, or households. Right now, the losses are being hidden through refinancing. But financial distress has a cost. Uncertainty makes households save instead of spend, businesses delay investment, and local governments cut back on services. The longer China waits, the harder the landing will be. Now! China's debt crisis is not just a line item in an economic report. It's the inevitable outcome of a growth model that prized investment over efficiency, quantity over quality, and today's stability over tomorrow's solvency. This mountain of debt won't quietly melt away. Beijing can either descend it step by step, with painful reforms, stricter discipline, and real transparency, or watch it give way in a sudden landslide that will send shockwaves far beyond its borders. For years, the strategy has been to extend and pretend, roll over the loans, refinance the losses, and hope the problem stays hidden. But the clock is now running out. And the only question now is this: will China defuse the bomb before it goes off? Or will the world be forced to deal with the fallout? Let's see. If you found this analysis valuable, please consider subscribing to Ceasefire Now for more deep dives into geopolitics. We would love to hear your thoughts. Drop your comments below and let us know what you think. Thank you for watching, and see you in the next video.